Hey, what's up, stock compounders? Brad here. So today I want to talk about compound interest and the ability to do compound math in your head, okay? This morning I put out a poll on LinkedIn, and the question I put on the poll was, using the rule of 72, how much faster does $100 become $10,000 at an 18% annual rate of return versus a 9% annual rate of return? And less than 1 in 5 people are getting the right answer on that, okay? So that inspired me to make a video about the rule of 72 and calculating kind of compound growth in your head. I'm sure everyone on YouTube knows how to do this in their head, but I'll also post this video to my LinkedIn community so that they can, hone their chops a little bit on the kind of mental math with compounding. So let's just go through this really quickly here. So what is the rule of 72? The rule of 72 lets you know how long it takes for your money to double, okay? That's kind of the magic of the rule of 72. So if you have an 18% rate of return, you take 72 divided by your rate of return, which would be 18% in this example. Tells you how many years it takes for your money to double. So at 18%, your money is going to double every 4 years. At 9%, you just do 72 divided by 9, and your money is going to double every 8 years, okay? So, we need to take it a step further to answer this question. How long does it take for $100 to become $10,000 at, let's start with an 18% rate of return? So first we have to figure out how many doubles is it to get from 100 to 10,000. So we start with 100, 200, 400, 800, 1600, 3200, 6400, 12,800. So after 7 doubles, we've exceeded our target of $10,000. So we'll just say it takes 7 doubles. Okay, it's a little less than that, but we'll just use nice round numbers here. So 7 doubles, if you have an 18% annual rate of return, like I said before, it takes 4 years for your money to double. So you just do 4 times 7, the number of doubles we need, and it takes 28 years to get from 100 to 10,000 with an 18% annual rate of return. So that's 28 years for 18%. Now, for the 9%, we're going to double every 8 years. We still need the 7 doubles, but each one of those is going to take 8 years. So we just do 7 times 8. That's going to be 56 years at a 9% annual rate of return. So back to my question, how much faster does 100 become 10,000 at an 18% annual rate of return versus a 9% annual rate of return? So you would just, it takes 28 years at 18%, 56 years at 9%. So you just subtract those two, and it's 28 years faster, which is also how long it takes to get from 100 to 10,000 at 18%. So the answer is 28 years faster. That's a lot of time saving just by going from a 9% rate of return to 18% rate of return. Now you might be thinking to yourself, where on earth am I going to get an 18% annual rate of return? Well, there's actually a lot of super investors, a lot of investors that are covered by Data Roma who have achieved that. If I recall correctly, Monish Pabrai is somewhere around 20%. Buffett, I think, is just north of 20%, both him and Munger. Bill Ackman is around, I believe he said 18 or 19%. So clearly it's possible to achieve these kinds of returns. A couple ideas, if you simply clone one of those great investors, that's a possible way to achieve those kinds of investment returns. A lot of you are familiar with the Magic Formula by Joel Greenblatt. Through his back testing of the Magic Formula, if you include those smaller market cap companies, kind of just north of 50 million, usually between 50 million and $1 billion, and you follow his approach of buying 20 to 30 of those Magic Formula stocks each year, his back-tested results show something like 25% annual returns. Okay, so clearly it's possible to achieve significantly higher returns than we're going to get over the long term in, say, an index fund like the S&P 500 index. But obviously there's no guarantees. Even with an index fund, there's no guarantee that we're going to be up each year. The market, looking back a couple decades, it seems like every maybe 7 to 10 years on average, the market will drop significantly, up to 50% in some cases. So, it's just part of the game where you're going to get those big drops. The key is to stick with your process through the drops. Have a long-term vision, because that's why a lot of investors underperform the market averages, like the S&P 500, is because they buy when everyone else is buying and when everyone is excited to buy, which is when prices tend to be highest, and they sell when everyone is fleeing the stock market because everyone is saying, oh, the stock market is so risky, because you look at your portfolio, you look at your neighbor's portfolio, and it looks like it's losing money, right? So everyone's fleeing because it looks risky because it's dropping. But, something to keep in mind, when the price is dropping, if you're a long-term investor, that is the best time to be piling in, owning shares of businesses, because they're all on sale. And, if you just keep that one point in mind, it's going to make you a better investor. So anyway, guys, I just wanted to share this example about using the rule of 72 to do kind of compound math in your head. Because if we're able to do that compound math in our head, which very few people are able to do, to think fluently in compounding, we're so often taught to think linearly. It's easy for us humans to think linearly. But when we're able to think in a compound growth kind of way, it changes the game. Okay, that's really how I was able to start my YouTube channel, and I've made a video every day for almost 4 months now, and I've been able to do that because I have the compound growth of my YouTube channel in mind. If you're thinking linearly, it's easy to get discouraged if you're just starting out because you think, oh, it's so slow. There's not much traction. I get a couple commenters and then maybe a couple more, but it's, looking back, the growth looks very slow. But when you look at it in terms of, all right, how long is it taking for me to double, my rate of new subscribers or my rate of increases in watch hours? How long is it taking to double? Okay, doubling in the early stages still looks small, right? I mean, you go from $1 to 4, 8, 16. They're all kind of in the same order of magnitude. But once that snowball starts picking up, you guys, you're talking massive jumps. That's where the exponential growth curve really starts to hit the hockey stick slope. So, and there's so many endeavors in our lives that would benefit from taking a compound growth perspective versus a linear growth perspective. And they really do follow more of a compound growth curve than a linear curve. So I encourage all of you to kind of look for those areas of your life that are more conducive to, acting in a compound growth kind of way. And, going through examples like this, training your mind to think in terms of compound growth, it's just going to help you kind of push through the challenges of taking on those endeavors that really can benefit one's life. So I will leave it at that, guys, but I'm going to put this poll on my YouTube community page, and you guys may see it as a post pop up in your feed. I hope you guys can do better than my LinkedIn connections have done so far. I'd like to see numbers much higher than 1 in 5 getting the answer correct to this question. So anyway, guys, that's all I got. Just a public service announcement about the power of thinking in a compound way. All right, guys, I'll see you in the next video. Take care.